Ladies and gentlemen, good day and welcome to the Compuage Infocom Limited Q2 FY21 earnings conference call. This conference call may contain forward-looking statements about the company, which are based on the beliefs, opinions, and expectation of the company as on date of this call. These statements are not the guarantees of future performance and involve risks and uncertainties that are difficult to predict. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Atul Mehta, Chairman and MD, Compuage Infocom Limited. Thank you, and over to you, sir.
Thank you. Good morning, ladies and gentlemen. Thank you for joining us on Compuage Infocom Limited's Q2 FY21 earnings conference call. I hope you and everyone around you is safe and in good health. Along with me today, we also have SGA, our investor relations advisors. We have uploaded our press release and results presentation on the stock exchanges, and I hope everybody had a chance to go through the same. Let me first start with business highlights. During Q2 FY21, we witnessed strong recovery in business as compared to previous quarter on the back of strong demand from all our channel partners, which are spread across the country. The demand surge was witnessed across all our product categories of IT, consumer, enterprise, mobility, and cloud-based products. Hence, our revenue, EBITDA, and PAT staged a strong recovery during Q2 as compared to Q1. This demand recovery, we believe, is led by multiple factors as follows. Surge in demand for IT products from corporates working from home as they continue to invest in devices, which enhances productivity and ensures safety and security of the data while employees continue to work from home. As students in schools and colleges continue to study through online medium, demand for laptops increase. Increased demand for mobiles as people spend more time on their devices during lockdown for connectivity and entertainment, and increased demand for fitness trackers and health devices as consumers in general have become more health conscious. Another point I would like to highlight is that we believe going forward, work from home is going to be a significant part of the work culture, leading to sustained demand for IT products, especially in the cloud and cyber security segments, as employees need to access data remotely, and at the same time, security of the data is as important. Hence, in line with our strategy to enhance our product offering in this more profitable segment, we have entered into cloud distribution agreement with Acronis for enabling resale of Acronis cyber security and data protection solutions during Q2. This tie-up would further enable our company to widen its horizon in cyber security segment, thereby further strengthening the company's product portfolio. We will continue to focus on partnering with reputed brands, whereby we can help add value to the brand as well as to our channel partners and end consumers. Although we are still catching up with revenue as compared to Q2 of last year, with newer brand additions, better product portfolio, and leaner cost structure, we expect to better our profitability as business reaches pre-COVID levels in times to come. Let me now give you an overview of our consolidated Q2 FY21 results. We reported a strong recovery in business as compared to previous quarter and rapidly gaining traction to reach business levels as compared to last year. Total income for Q2 FY21 stood at rupees 1,090 crores as compared to rupees 1,292 crores in Q2 FY20 and rupees 561 crores in previous quarter. Gross profit for Q2 FY21 stood at 45.2 crores as compared to rupees 54.9 crores in Q2 FY20 and rupees 29.3 crores in the previous quarter. EBITDA and for Q2 FY21 stood at 25.3 crores as compared to 29.8 crores in Q2 FY20 and rupees 13.4 crores in previous quarter. EBITDA margins for Q2 FY21 stood at 2.3% at similar levels when compared to Q2 FY20. Several cost optimization initiatives undertaken by us during these last 6 to 8 months has led us to maintain our EBITDA margins as compared to last year. PAT for Q2 FY21 stood at rupees 6.8 crores as compared to rupees 10.4 crores in Q2 FY20 and rupees 0.2 crore in previous quarter. Speaking about our liquidity position, our total debt, which includes both long-term and short-term, stood at 487 crores as on September 20. Cash and cash equivalents as on September 20 stood at 78 crores. Hence, our net debt stands at 409 crores. We continue to generate healthy cash flows and can comfortably service our debt. Our net worth as on September 20 stands at rupees 208 crores. To conclude, we believe that penetration of IT products in India is much lesser when compared to the developed countries. Hence, there is long-term growth opportunity for the industry and thus for our company to grow. With the economy now strongly recovering from the pandemic, with enhanced product offerings, pan-India distribution reach and efficient supply chain, we are well placed to grow strongly and sustained in the times to come. With this, I now open the floor for Q&A.
Thank you very much. Ladies and gentlemen, we will now begin the question answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handset while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Ankit Agarwal from Arc Capital. Please go ahead.
Yeah, thanks for the opportunity. Sir, I have a couple of questions. So, sir, now that the lockdown regulations are easing and people, in a staggered way, are started going to office, do you think that the demand due to this thing will reduce?
So, lot of questions. Very frankly, we don't have definite answers because this is something that we are seeing for the first time in our lifespan.
Right.
So it's going to be difficult to know, but I think what is evident is now companies, people want to be prepared for all kinds of eventualities. While there was a surge in demand for laptops primarily and maybe to some extent mobile phones, so we may see better than normal demand in times to come. But whether the same increased demand will be there is something that only time will tell us.
Okay, fine, sir. And sir, I also have a couple of questions on the financial. Sir, regarding debt, what's the plan there for the next 2 years in terms of reducing it?
So, reducing debt will be difficult because we want to continue the growth momentum that we've built in the last decade or so. However, we will ensure that we do not grow only on debt. We will have a balanced growth in terms of, or we will have a growth which will not be riding on debt alone is what I would mention.
Okay, fair enough. And so one last question on the working capital. So, sir, what's the working capital cycle in number of days?
So working capital cycle in number of days is closer to about 59 days as we end quarter 2.
And given the current situation, like, are you facing any issues on the receivable side?
I wouldn't say there are any issues or concerns. Yes, from the enterprise segment, there are delays which are happening, but I wouldn't call it concerning, which is understandable as project execution gets delayed. They have their challenges because their recovery is slow. While they do meet some of the commitments from their internal resources, all of it cannot be met, and therefore there is some delays happening on that front.
Okay, fine, sir. That answers all my questions. Thanks and best of luck.
Thank you.
Thank you. The next question is from the line of Isha Savla from Arya Securities. Please go ahead.
Hello, sir. I had a couple of questions. I wanted to know that how was the recent festive season for the company? Basically, I wanted to understand that which segment did well for us and which were performed negatively during the quarter two.
So, Compuage has taken a very balanced view amongst all our 6 divisions that we have, and therefore we are not dependent in the festive period. Products like laptops and smartphones are typical categories which do better than normal. And since we are not highly centric on these 2 categories alone, we are very indifferent to say that maybe like a online company, there would be a surge for us. There is no surge on account of the festive buying during this period.
Okay, sir, can you provide segmental revenue contribution for quarter two?
The segmental revenue I can share, while it would be a little, we've still not stabilized with all these upheavals happening in the marketplace, but I can possibly share the segmental revenue for the H1 of this current financial year. The consumer segment would be at approximately 35%. The enterprise segment would be at about 44%. Mobility would be at about 18 to 19%. Cloud would be at about 2 to 3%. These are the major verticals. Of course, we have 2 other verticals. One is the lifestyle and hardware services. They are still relatively smaller in terms of percentages.
Okay, sir. Thank you.
Thank you. Before we take the next question, a reminder to the participants, if you wish to ask a question, please press star then 1 on your touchtone telephone. The next question is from the line of Ayush Oberoi from VD Securities. Please go ahead.
Yeah, sir. Thank you for giving me the opportunity. Sir, as e-commerce is on a boom and due to the festive sales, bumper festive sales, did our company benefit from this?
As I just mentioned, that the products which primarily do well during these periods are laptops and smartphones. And while we are there in this category, if we were to put the total business coming out of the laptops and smartphones would be less than 25 to 30% for the company. And therefore, and also there has been some constraints on the supply. So we've not seen a surge on these categories for Compuage.
Okay. So how many brands do you expect to be added in the next year?
So we've already added 2 plus 1 in this current calendar year. We've added Goki, we've added Dawa, and we've added HP Services. Therefore, I mentioned 2 plus 1. We are in discussions and we hope to close at least 2 more before the end of this financial year or latest by June. Until it closes, we can never say for sure because discussions are on with several brands. But the plan is to continue to add anywhere between in the region of 2 to 3 brands a year, plus more on the cloud offering. Okay. And yes, we signed up the Acronis one in terms of the cloud security space also, which I forgot to mention.
Yeah, sir. That was very helpful. And what would be the revenue contribution from hardware services in Q2?
Hardware services has been affected because of the ability for the team to go and service the products. So it's still in the stage of settling down because a lot of our services are provided on field, and that continues to be constrained.
Okay. That was very helpful, sir. Thank you.
Thank you.
Thank you. Before we take the next question, a reminder to the participants, if you wish to ask a question, please press star, then 1 on your touchtone telephone. The next question is from the line of Atul Kothari from Frogwell Securities. Please go ahead.
Thank you, sir, for the opportunity. Sir, I have a few questions. Sir, my first question would be as to when can we expect our business to reach pre-COVID levels?
So we are hoping for it to happen in Q4.
In Q4?
Yeah.
Okay. And sir, so is it possible for us to, in terms of our FY20 revenue, how much percentage are we likely to reach to approximately as a percentage of our total FY20 revenue?
Very difficult to comment because still things have not stabilized. That gives us a clear picture in terms of, we will close Q3 at this and Q4 at this. There's still a lot of uncertainty happening in the marketplace. I can only mention that we will try and make up. First, of course, our goal is to hit the pre-COVID levels, which is what we're going to, as I mentioned, we're going to try and hit it by Q4 and minimize the gap that we have for the year over year. So we are not placing any numbers at this point of time. Our desire is going to be to minimize the gap year over year.
Okay. Sure. And sir, is it possible for you to provide an outlook in terms of revenue and profitability over the next 2-3 years?
We would not like to do that at this moment. We don't know when we're going to stabilize our operations completely, because what's happening in the western part of the world in terms of COVID, and if it flows into India, like we have just seen the announcement of Ahmedabad getting locked down for 48 hours, and spread of cases in Delhi, and how it will affect life and business in general. So it's going to be very, very difficult to say that this is what our plans are, and we are very confident of achieving this. And yes, we hope to do well because the demand for, as I mentioned in my earlier communication, that demand for IT products will go up because the penetration level in the country is low, and the need is now felt more with more and more things going on the digitization route. So we are hopeful that we should be able to get back on growth track from next financial year.
Okay, sir. And sir, are you having any plans to raise equities over the next 1 year or so?
So we'll just wait. Yes, we definitely want to raise equity so that we have a balanced contribution between equity and debt. So we've not yet made any concrete plans as to how much and when, but yes, over the next 3 years, there will be a balanced infusion of funds on both counts, equity as well as debt.
Okay, sir. So that was helpful. Thank you, sir.
Thank you.
Thanks for the opportunity.
Thank you. A reminder to all participants present in this conference, if you wish to ask a question, please press star, then 1 on your touchtone telephone. The next question is from the line of Navneet Bhaya, individual investor. Please go ahead.
Hello?
Hello.
Hi, sir.
Go ahead, sir.
Yeah, hi. This is Navneet. Sir, I wanted to yeah, you've been...
So sorry to interrupt, but your audio is not very audible. Could you please repeat yourself?
Is it better now?
Yes, thank you.
Okay. So I wanted your views on your balance sheet construct. Over the last 3 years, your debt to equity has consistently ranged between about 2.5 to 3x. You just spoke about, raising equity at an opportune moment so that debt equity is balanced. But the current market cap of the company is about 90 odd crores. So raising equity from the public markets, even if you dilute a decent 5-10%, you will get maybe 9 or 10 crores. So I wanted to understand your views on your balance sheet construct. Your turnover has been increasing, but so has your debt also been. If I look at your debt divided by your turnover, that percentage has only increased. So majority of the growth has been funded out of the debt, and which has resulted in lower profitability by your company. Your interest to your EBITDA is almost 70%. So I wanted your views on that. Your operations and all, you've pretty well, and I think there's good progress over there. But yeah.
Last few years, we've grown on debt, and we've realized that. And so moving forward, as I mentioned, we will be ensuring that there's going to be a balanced growth coming out of equity and debt. And as very rightly said by you, that our market cap is ranging in the region of about 90 crores as against our net worth, which is closer to about 208 crores. So which doesn't reflect truly in terms of the company's intrinsic value. So that's why we are not making any definite, we are not able to share any definite plans as to how much and when we're going to raise, because we are conscious of the fact that we need to raise funds at the right valuation so that the company benefits out of it. So it's something that we are just waiting and watching, and we will act appropriately. But yes, we do not want to grow entirely out of debt, and therefore this is something that will be paramount in all our consideration.
Perfectly. So one of my view is, I think one of the reason why the market cap of the company is lower than the book value itself is the consistent increase in debt and the interest eating up about 70% of the EBITDA that you generate. So given that, do you have any target ratio of debt to equity, or since yours is a distribution business, debt to turnover, or any target number that you have in terms of absolute debt, which you can share with us?
So we do understand that debt has been higher because we've grown primarily on debt in the last few years, and money, working capital is our raw material, and therefore, so what we've done as step one in the last financial year, even at the cost of taking a hit on the top line, we focused on growing the business and enhancing the bottom line, which we have successfully demonstrated. And that will change the ratio of interest coverage in terms of EBITDA, etc. And that is going to be the way forward. We were on that journey, which got I would say, affected this year on account of the environment.
Yeah.
So the moment the environment stabilizes, we will focus on growing the businesses in the profitable segments, even if it means reducing focus or reducing certain businesses, so that our debt doesn't go in the same proportion, and the contribution towards profitability is on the higher side. So we are conscious of the fact and are keeping that paramount to the future growth plans that the company has.
That's very nice to know. And the last thing is, with the interest rates coming down significantly, are you seeing banks passing on interest benefits to you? That can, of course, increase your profitability significantly, because interest is a big component below your EBITDA.
Not really. There's not been much change. I think what we see in news and what we see happening is not being translated into actual finance costs to us from our banking partners. It's something that we are constantly working towards. But as we speak, it has not yet translated into any benefits for the company.
Okay, understand. Thank you so much. That's all from me.
Thank you.
Thank you. A reminder to all participants present in this conference, if you wish to ask a question, please press star then 1 on your touchtone telephone. A reminder to all participants present in this conference, if you wish to ask a question, please press star then 1 on your touchtone telephone. This is a reminder to all participants present in this conference. If you wish to ask a question, please press star then 1 on your touchtone telephone. Well, ladies and gentlemen, that seems to be the last question for today. I would now like to hand the conference over to Mr. Atul Mehta for his closing comments. Over to you, sir.
Thank you everyone for joining the call. I hope I've been able to answer most of the queries. In case if you still have any queries left out or that you may come about, you may contact SGR Investor Relations Partners. Thank you for your valued time.
Thank you. On behalf of Compuage Infocom Limited, that concludes this conference. Thank you all for joining. You may now disconnect your lines.